Here we want to talk first. We want to look at what happened with the Fed. What are expectations for the Fed going forward? And I think this is a good chart from the Bloomberg economics team talking about where are net purchases of treasuries, net purchases of mortgage-backed securities. So here you can see that there's a bit of a delay in terms of what is being done in 2022. But then as you get into 2023, you're going to start to see a bit more aggressive sales. So we've had net purchases of treasuries and MBS, and now we're going to start to see some net sales. Now there's going to be a delay. We've seen that for those that were listening to us prior to the Fed announcement. We expected them to just sit tight on the balance sheet. We didn't expect them to sell anything, but just by doing nothing, it'll naturally shrink as some of these things expire, they mature. But this is looking at the Fed funds path based on expectations in the market. So there's an expectation of a neutral rate of getting back to about 2.5%. And I'll show you what that means versus what the futures are saying, but what the Fed is saying. So now if we look at the dots, which everybody who doesn't love dots, here you have what the Fed, the futures are saying, which is close to about that 2.45%. But when you look at the FOMC governors, they are expecting to be at 2.75%. Now, Summers has made comments that we could be as high as 4 to 5%. Again, I don't, as much as I want to see that, and I think that is the right thing to do, it is very unlikely we get there because the market would be an absolute panic if that were to be the case. So I think you're going to see kind of that steady move up. Some of the things that have changed is the expectations of how quickly we can get to that point. So here now you can see that there is we're actually approaching almost a nine expected increases and so between March and the end of 2022. Here you can see that this one is at 7.4, which means at least 7 is expected, and we're actually starting to see that ramp up, and now we're getting a bit closer to about 9 increases expected. The market is pricing a 65% probability of 50 basis points. As those that have been following me, I've been saying that, we're going to be 25, 25, 25. I'm going to correct that now. I actually do think that we could get 50 basis points just because inflation has continued to ramp up so aggressively. We are at below the natural rate of unemployment. I think that it would behoove them to do a 50 basis point, especially if the market is expecting it. So I think it's going to be something to watch of how are they commenting, what are their comments, because they definitely want to prepare the market for it. And that makes that 50 basis point, I think, very likely. This just gives you an idea of now there's an expectation of being at 2%, of a Fed funds rate of 2% by January of 23. This is obviously a huge shift and change in the mantra of what the market is expecting. But as I wrote the article back in February of 2021, they're going to be beholden to yield. They're going to be beholden to the market. And the market's already pricing this in. We already have the 30-year mortgage rate over 4%. We're going to continue to see a lot of these expectations moving up. And then the number of participants reporting weighted upside risk to core PC inflation, just so you know, more people in the Fed are now expecting inflation. It's nice of them to join the party, which we've all been experiencing. But I guess they're the people that do the shopping for them have finally reported back that numbers are going higher. So they're finally recognizing that fact. Now, when you look at the shift, as we've been talking about, we've had a big adjustment in the yield curve. There have been inverses in the 2 and 20, the 3 and 7, the 3 and 10. So again, you're starting to see some of these reversals, and then the 2-year yields rise more than previous Fed tightening cycles. Again, the expectation, the shift that we're seeing is why we do think that there's going to be a more aggressive move on the Fed front, because yields are telling them that they have to try to get in front of this, which is something that I think they're going to be forced to do. All of that has now created Treasuries have their third worst drawdown in a century. So looking at over the last 100 years, the U.S. Treasury drawdown from prior highs ranks in line with where we were in the Great Depression, as well as in the 70s, to give you an idea of just how bad that drawdown is, which is some of the things that the Fed is going to try to manage. But where is inflation hitting us? I mean, everyone talks about inflation. We've talked about inflation, but where is it altering behaviors? And I thought this was a fantastic chart talking about how consumers are planning to spend more on necessities. So you look at groceries, utilities, childcare, self-care, home entertainment, rent, mortgage. All of those things are going to come at a think of it as a scale. The scale has to balance. So where is that going to hit? Home improvement, travel, clothing, out-of-home dining, out-of-home entertainment. All of those things. Do you need to go to a concert? Is a concert that is $200 a ticket worth it? And for some, it might be that's how I relax. That's how I blow off some steam. So for me, I'm not saying for me, I'm talking the mythical person. For me, that's how but I don't like eating out. So you know what? I'm not going to go to dinner before the concert, or I'm going to eat something small, or some of these shifts. Everyone's different. Everyone's spending habits are different. I personally don't like restaurants. I mean, I get it. It's nice. I'm not a huge restaurant fan. So for me, I can take or leave it. Travel, I like to travel. Again, take or leave it. Clothing, for anybody that follows, I wear Under Armour, very cheap. I buy sales. I wait till I have a gift card for my birthday. I'm not going crazy on it. So there's some things, but we, my wife and my family, we enjoy eating at home. We enjoy eating as a family. So we spend more on groceries. So now as that shifts, again, these are the things that people are weighing. It takes time. This is not something where demand destruction, instant, happened. It's no, that there is a pivot, there's a shift. And this is where we're already seeing the altering behaviors. But the consumer is fickle. But it happens slowly and then all at once. And that's what we're continuing to see, which is why when you start looking at that sticky CPI grinding higher, that's what's going to kick people in the face, because the flexible is not going anywhere. It's going up again. And that's going to pull that stickiness up, and you're just not going to see that kind of shift, because flexible CPI is surging off the charts beyond 1970s and 1980 levels. I look at these numbers and I'm like, there's no way this can be real. But my wife went to BJ's for food, and the food bill was 22% month over month. Now, given it could have been when that shipment came in, when this shipment came in, it could have been a mark to market. So we could have been ahead of the game for the first for the other 2 months or other month, but you can't see those kind of shifts and assume people are not going to change direction. 1 month is okay. But when you start getting multiple months of either increased levels or just those sticky levels, again, that's where you start to get those hits. And then the proportion of components rising faster than 1% month over month is at 45%. The only time that was greater was 1980 and 1974 was the only time that we had components rising faster on a month over month basis. I mean, you're talking about just insane levels. And this is just showing the rate of change is accelerating again. Now, remember, we did it. We expected it to accelerate in March. We did not expect this. And this is because of Russia, Ukraine. This is because of energy, where it's just this, and then it's also included of what we've been talking about wages and shifts in that nature, which is creating this kind of this negative feedback loop and these underlying problems, which is all relating to U.S. CEO confidence is in free fall. When you consider that wages are running at 40-year highs and lead indicators suggest top-line growth is peaking, it's not a surprise to see margins getting absolutely annihilated, and obviously the decline in CEO confidence in terms of what is happening, which again is just showing you where the trajectory is. Manufacturing output was up. Here you can see that there was that increase from utilities last month. That has come down. Now you're having non-durable manufacturing, durable manufacturing. Some of the inventories have caught up. You're starting to see some of that get back. But we're going to talk about leading indicators coming from the regional Fed areas, which is showing a bigger slowdown. Now, assemblies are facing more disruptions. Those disruptions are getting worse again. So the supply chain, now, again, it didn't get back to normal, but it improved. And now all of those kind of improvement gains are getting wiped out, and you're seeing an additional decline in terms of where some of these things are going. Now, PPI is still outpacing CPI. The spread is moving up off of pandemic lows, but has now reversed lower. So we're still at a spread in terms of where the PPI is, where costs are, and where CPI is. So you can still see more price coming through. More of this trying to get passed through to the end user, which is what we're going to talk about in the next segment. So then obviously the economic sentiment index is moving to the lows. We're back below where we were at the beginning of 2021. And when you look at still people are confident about new jobs, personal finances are still in a better state. But there is a lot of fear around U.S. economy, the U.S. economy, as we talked about in the EIA show. And new homes and major purchases are continuing to just get absolutely annihilated. Now, import price index off through the roof for semiconductors. Again, this is going to be the overarching theme of just a huge overhang in the market as these costs continue to explode higher and create these underlying pressure points. Now, when you look at CPI inflation surging relative to its 5-year average, the spread is at its widest since 1980. So again, when on a 5-year average, on a rolling average, on a 3-month, 12-month, 6-month, I don't care what you use, we are in unprecedented times. It's happened before. But we also know what that looked like, and we weren't coming into the problems like we are with Russia, Ukraine. We didn't just blindly stimulate on a fiscal and monetary level. We didn't have at-time deliveries the way we do today. We didn't have, we still had U.S. manufacturing onshore. Like all of these things make it, as we say, history doesn't repeat itself, but it rhymes. So we're going through something similar with very different impacts that I think are going to become an underlying problem or remain an underlying problem. And then that negative growth, the growth tax inverted. So again, pulling down that PMI, which we're going to talk about more in the next segment. And then people are kind of waking up to this fact of, instead of the shift, it's gone from the search activity on Google has gone from transitory to stagflation. And what does it mean? How is it going to change? So it's not surprising to see people trying to prepare for the pain that is to come. And it's already showing up. Retail sales, less auto and glass, was expected to be up 0.4%. It was instead negative 0.4%. Retail sales control group was expected to be up 0.3%, came in at a negative 1.2%. Again, these are things that we expect to continue to progress in that way. And then the percent change in median weekly checking account balances, still higher, but you're seeing, again, that trend coming back down as people pull more money into the market in order to cover for these broad shortfalls as they look to try to maintain some semblance of normal spending. But as this dwindles down, as we've been talking about with savings, as we've been talking about with borrowing, with credit card debt, we've continued to see that it started in December and has only gotten worse as people have tried to, again, just cover their additional costs as both flexible and sticky inflation continue to hit them hard, something that we're going to talk about more aggressively in the next segment, as well as housing.